Dear Minister Schäfer, thank you very much for your speak. We take you by your word. Ladies and gentlemen, my name is Hubert Osveda. I'm Managing Director of Frankfurt Main Finance, and I have the pleasure to announce a little change in the sequence of the speeches, as Commissioner Jonathan Hill is still on its way in the car. So he's approaching our conference, and he will be with us in a few minutes, but we don't know exactly how many of those few minutes we have. And hence I have the pleasure to announce Mr. Grillo, the President of the Federation of German Industries, to start with what Minister Schäfer said before, the real economy. So we learn the real lessons from the real economy for real growth. Very welcome, Mr. Grillo.
So let's see how long I have to talk, depending on the commissioner. Commissioner is coming or not. Dear Dr. Rettig, ladies and gentlemen, thank you for granting me this opportunity to speak to you, to speak at the Frankfurt Finance Summit. It's a great pleasure to be here. I mentioned it before, I'm always happy to be in Frankfurt. I started my career in Frankfurt some 20 years ago or 20-something ago with Arthur Andersen. And the reason that they do not exist anymore is not me, to be honest. Of course, it's not only the financial markets that concern us, but also the prospects of Europe's economic development seen as a whole. This future outlook is of absolutely decisive importance for German industry, for the real world. Across the whole of Europe, what we now need is to focus clearly on growth and employment. You mentioned it. Many jobs have been lost as a result of the massive financial crisis. We have far too many unemployed, far too many young people lacking good prospects. Europe needs new jobs in industry, in modern services, in new enterprises. None of this can be achieved without enterprises investing in new plant and machinery, factories and business models. Of course, the budgets in the public sector must continue to be consolidated with a proper sense of proportion and with determination. Here, Europe is already on a good course. Of course, it differs from country to country, but we won't discuss it today. And we also need stability regarding the value of money. Here, the central banks have, again, recently taken firm action to restore the trend in prices to normal for the medium term. Yet our compass should above all be aimed at the twin goals of growth and employment. Fortunately, the European Commission has now set out a major program designed to ensure that these objectives can be achieved. I'm sure that Commissioner Hill will talk about this also later. Ladies and gentlemen, you have chosen a good point in time for your conference, namely the season of spring, as we can see outside. And indeed, Europe's economy is currently enjoying a springtime. Not only the stock exchange, or as a result, probably. Low oil prices, boosts provided by monetary policy, a weaker euro and numerous reforms in former crisis countries of the Eurozone can be entered on the credit side. This year, most of Europe's economies are likely to record substantially higher rates of growth than last year. Germany is also probably facing a good year for its economy in 2015. We will not quite equal the level of Spanish or Irish growth rates, but Germany should provide a real boost for the rest of Europe. We're not sure if it's 1.5, but I think there are chances that we even grow by almost 2%. And forces for growth should continue to be backed by good policies. This can only succeed if countries press ahead with national structural reforms. Oil at a reasonable price, low interest rates and a weak euro are not in themselves enough and not stable enough to confer the ability to cope with the risk of global politics and the global economy. Speaking frankly, the economic situation in Russia and Ukraine is bad. We are expecting a severe recession there. Stabilizing Greece remains a huge challenge, really a challenge, and I think we can be happy to have a finance minister in Germany who is a senior person and who helps a little bit in this topic. I won't discuss it anymore. The expected change of courses by the Fed in monetary policy could trigger unease in the financial markets also, so we must be careful. And in view of such problems, the need for sound economic policy in Europe takes on all that much more importance. In order to continue to safeguard growth and prosperity, and that's the name of the game, growth and prosperity, in Germany and Europe in the future, we are in urgent need of more investment, both public and private. Europe is not yet adequately equipped for the disruptive challenges of the digital age. In order to retain our place at the top of the league for innovation, and that's also our goal, to place at the top and to stay there, top of the league. Our enterprises need more courage for new business models, but also active and wholehearted support from the political sphere. It will above all be important to shape the right framework conditions for financing innovation with regard to the digital economy. And we were yesterday at the CeBIT in Hanover, and of course everybody talks about digitalization, about rules, standards, chances, risks. So digital economy, that's also for the finance industry, I think, the future very important topic. Up to now, 28 different national business promotion programs, tax rules and stock exchange regulations run counter to what is required. This particularism in the market and in promoting business is no longer in tune with the times. So Europe is falling behind in the international competition for the best brains and projects. And in my view, the investment offensive initiated by Commission President Jean-Claude Juncker is an important step in the right direction. The European Fund for Strategic Investment, EFSI, as a central building block for a comprehensive investment strategy, can contribute to closing the investment gap in Europe. But how far the plan can succeed in mobilizing private investments to the desired extent depends crucially on the overall environment being conducive to investment. And we appreciate that the European Commission also sees this very clearly. We are all aware that the Commission's scheme will only be able to achieve the desired effect if and only if it prompts additional investment. That is the real intention behind the initiative. The mere relabeling of financing facilities already in existence, which would in any case have been possible without the elements of the EFSI program, will be of no use. And every effort must be made to ensure that the new plan avoids the weaknesses contained in EU investment promotion. Up to now, we have seen already some programs. The resources originating from structural and regional funds have frequently fizzled out without any lasting knock-on effects. Ladies and gentlemen, let us not harbor any illusions. Weak investment in Europe cannot simply be attributed to a lack of capital alone. That is why EFSI alone is not sufficient to trigger the necessary impulses for investment and growth in Europe. What we urgently need is a comprehensive improvement in the climate and conditions for investment in Europe. The creation of an effective European capital market union can make an important contribution to this goal. In future, business enterprises will have a greater need of access to the capital market in order to place their sources of finance on a broad foundation. We welcome the plans for a capital market union, seeing them also in the context of a further reaching European integration strategy to which the BDI has always given its full support. And nonetheless, there is one thing that should be clear. The European states have their own finance traditions, corporate structures, and financing requirements. To some extent, this creates natural borders, confining the role of the capital market in the context of corporate financing. But first and foremost, the task must be to complete the European financial single market, in which many still gapes, and to achieve a balance in the agenda for banking and financial market regulation, with greater consideration being given to the properly understood interests of the real economy. Inconsistencies between diverse regulatory approaches, inappropriate incentives to reduce systemic risks, multiple burdens on the banking sector, and an increasing shifting of risks to the enterprise taking our loans are high hurdles for a viable capital market union to surmount. Our companies are increasingly calling into question the effectiveness and the benefit of such a regulatory strategy. Multiple burdens imposed on the banking and finance sector inevitably impact on the real economy and consequently on investment, growth, and employment. That would be to defeat the purpose. That must be clear for the politicians. A cause of special concern to me is a seemingly never-ending discussion on separating the retail and investment sides of the banking business. And my clear option here, I made an apprenticeship as Deutsche Bank, so I'm a little bit a banker. Such a separation is mistaken. There must be no threat posed to the substance of the proven universal banking system, which guarantees the offer of financial services from a single source. A greater sense of proportion is also required in the further regulation of the derivatives markets and securitization, the shadow banking sector, and in the taxation of financial transactions. The fact is that well-regulated securitization markets can provide significant boosts for financing investments by medium-sized and large companies. They also open up new paths for financing infrastructure. To put it in a nutshell, bank-based and capital market-based financing models must be intelligently interlinked. Only in this way will the planned capital market union be in a position to make a positive, and that's the goal, a positive contribution to more investment and growth in Europe. Ladies and gentlemen, above all, Europe is in urgent need of more equity capital in order to master the huge challenges of the digital economy. Inadequate venture capital is often a central bottleneck factor for new business startups. It is absurd that innovative enterprises, when they require more than startup financing, have to fly to San Francisco in order to procure capital. San Francisco is a nice area, a nice town, but we have also nice places here. The EU should, at long last, venture to take a great step as a serious answer to Silicon Valley. That is a big demand to make, but we must chart the right course, and the time is now. That's also something we discussed yesterday in Hanover. The resources of the new European Investment Fund should therefore principally serve to reduce the bottleneck, restricting venture capital for financing innovation. It is also clear that fund resources alone cannot bridge the manifest shortfall in venture capital in Germany and Europe. Innovative business enterprises require a dependable framework which reforms the taxation and regulatory environment in a consistent fashion in order to make equity funding more attractive for investors from Europe and from throughout the world. Germany should lead the way in setting a good example here. I'm therefore appealing to the federal government to bring in as soon as possible legislation designed to enhance the framework conditions for venture capital from a single source and geared to practical business requirements. At the same time, at European level, there is a need for the capital market and supervisory environment to be subjected to a critical examination. Potential institutional investors must not be put off by constricting regulations. Less restrictive capital and liquidity provisions and investment rules for banks, insurance companies and funds could encourage important groups of investors to commit themselves to participating with capital, and everybody knows there's enough money flowing around looking for investments. Ladies and gentlemen, we, the Federation of German Industries, give our firm backing to German and European policymakers in their assignment of resolutely implementing the agenda for growth, a task that is certainly by no means a simple one. The real economy in Europe needs a clear commitment rejecting particularism and in favor of a functioning EU single market from which all member states benefit. This is the way to make Europe more competitive, and that's what we need. In this way, the process of de-industrialization in Europe can be stopped and put into reverse as a process of re-industrialization, and that's important on the long run. And in this way, we can plot the course for economic prosperity and employment in Europe. And once more, that's the goal. Thank you very much for your attention. To be honest, I have the speech of Mr. Hill also in my paper, but I'm sure.